Constructing an income statement involves several key steps, each of which contributes to providing a comprehensive view of a company's financial performance over a specific period. Here's a detailed 10-step guide. Determine the reporting period. The first step in constructing an income statement is to define the time period for which the statement will be prepared. This could be a quarter, a fiscal year, or any other reporting period relevant to the company's operations. The period chosen will frame the data that follows. Gather revenue data. Begin by collecting all sources of revenue that the company has earned during the reporting period. This includes sales of goods and services, rental income, interest income, and any other forms of income. Revenue is typically the starting point of the income statement as it reflects the total amount generated by the company's core activities. Calculate cost of goods sold, COGS. The next step is to determine the cost of goods sold, which represents the direct costs attributable to the production of goods sold by the company. This includes costs such as raw materials, labor, and manufacturing overhead. COGS is subtracted from revenue to determine the gross profit. Compute gross profit. Subtract the cost of goods sold from the total revenue to arrive at the gross profit. Gross profit measures the efficiency of production and is an important indicator of how well a company is managing its direct costs in relation to its sales. Identify operating expenses. Next, identify and list all operating expenses incurred during the period. These include selling, general, and administrative expenses, SG&A, such as salaries, rent, utilities, and marketing expenses. Operating expenses are necessary for running the business, but are not directly tied to the production of goods. Calculate operating income. Subtract the total operating expenses from the gross profit to calculate the operating income. This figure reflects the profitability of the company's core business operations before accounting for non-operating items like interest and taxes. Account for non-operating items. Include any non-operating income and expenses that are not directly related to the company's core operations. This can include interest income, interest expense, gains or losses from investments, and other incidental revenues or costs. Adjusting for these items provides a more accurate picture of overall financial performance. Determine income before taxes. Add or subtract the non-operating items from the operating income to get the income before taxes. This figure provides insight into the company's profitability after accounting for all income and expenses, excluding taxes. Calculate income tax expense. Compute the income tax expense based on the company's taxable income. This involves applying the relevant tax rates to the income before taxes. The tax expense reflects the amount the company must pay to the government and impacts the net income. Compute net income. Finally, subtract the income tax expense from the income before taxes to determine the net income. Net income represents the company's overall profitability after all expenses, including taxes, have been deducted. It's a crucial indicator of financial performance and is often used by investors and stakeholders to assess the company's success. Each step in constructing an income statement builds upon the previous one, ensuring that the final document provides a clear and accurate representation of the company's financial performance over the specified period. The income statement is essential for internal management, investors, and other stakeholders to make informed decisions about the company.